Hello and welcome back to Principles of Accounting 2. Happy to have you all with us today as we talk about a couple of very important concepts in accounting. This is going to be a little bit of a continuation of our conversation we had last week on budgeting. But in addition to budgeting, we're going to talk about this concept called standard costs, which is directly related to another very important concept called cost variance. And it's a very important concept, and I'm going to take my time explaining it to you. And if you have questions about these concepts, just feel free to unmute your microphone and ask your question because these are relatively challenging concepts for most students to understand. So that's why I'm going to take my time with it. Okay. So before we jump into the lecture, just to kind of recap where we are, last week we talked about budgeting. That was in week 10. This week, we're talking a little bit more about budgeting, but we're also talking about cost variance and standard costs. Next week, we'll jump into performance management. The week after that will be relevant costs. The week after that will be capital budgeting and investments. And then the last week of the course will be a report that you'll write on QuickBooks. Okay. So if you want to look at that early, you're more than welcome to. And in fact, I would recommend that you do. Just because, it's a report, it's not really something that you might not be used to doing, especially in a course like this. So down in week 15, feel free to take a look at that in advance. I think you'll find it to be, somewhat challenging. So consider starting early on writing that report, okay? And that's in week 15. So just a little encouragement to work ahead, yeah? Okay, so that's the roadmap. Of course, that's we still got almost a month, but before the end of the course. Course ends on April 26. April 26. Okay, which I think is a Friday, if I'm not mistaken. You might be wondering why April 26, because we have students in this class that are graduating, and I need to have your final grades on into the registrar April 27. Yeah. So I figure just have everyone complete at the same time. It's easier that way for you and for me. Yep. Okay. So that's the roadmap. Let's jump into our conversation on flexible budgeting and standard costs. Okay. First, I want to talk about the budget. As you recall, the budget provides the business with a plan to move forward, right? The idea with a budget is that we use it to effectively manage our costs based off of our expected revenue. As you recall from our conversation last week about master budgeting, the master budget, we start with the sales budget, remember? Start with the sales budget that helps us to tell us what the production budget is. The production budget tells us our raw materials budget, labor budget, overhead budget, right? We put all that together and it drives us to our cash budget. And of course, we got a couple of other budgets along the way, right? We put it all together and that equals our master budget. And the idea here is that we're going to compare our performance to our budget to our actual results. Yep. Our actual results, that's the performance. We're going to compare that to our budget, right? Compare the actual performance to the budget. What we actually paid versus what was budgeted. You see? That is what gives us this thing called a variance. And we're going to talk more about that here shortly. There are two types of budgets, really. One is called a fixed budget, and the other one is called a flexible budget. A fixed budget, which is also known as a static budget, is based off of one amount, okay? And it stays the same throughout that year, all right? That's why we call it fixed. It doesn't change. We don't have the ability to change the budget. It's fixed, you see? It stays the same regardless of the level of output. For example, let's say I plan to make 100 units, to produce and sell 100 units, okay? But I actually end up producing 140 units. If it's a fixed budget, that's kind of a problem because I budgeted sales, variable costs, right? I budgeted the costs. So if I end up producing and selling more than what I said I was going to do, it's good for sales dollars, but it's not great for all your costs. And I cannot adjust the budget because I produced more, you see? Or if I produced less, the same consequence applies. So you see, a fixed budget means that it does not change regardless of the level of output. That's what a fixed budget is. On the other hand, a business can have what's called a flexible budget. I love flexible budgets because it allows me to adjust for changes in the level of output, level of business, level of activity. You see, if I sell more, I can increase my budget. If I sell less, I can decrease my budget. That's what flexibility provides. When we talk about flexible budgeting, we can pivot one way or the other based off of the level of output. It's flexible. Yeah. When we do flexible budgeting, we typically do this based off of levels of activity, based off of our capacity. Okay? 80% capacity, 100% capacity, 120% capacity. Those are our different levels of capacity, you see? And I can adjust the budget based off of my capacity to produce. So we'll talk more about that here shortly. I just wanted you to understand the difference between fixed and flexible budgets. I'm going to show you an example of a fixed budget. You'll notice here that the fixed budget is fixed. Once I set the budget, it stays in place and it does not change regardless of the level of output. So here I have a budget to produce and sell 100 units. Okay? I produce and sell 100 units. That means I should be budgeting to receive $80,000 in sales. It should cost me $36,000 to produce those 100 units, giving me a contribution margin of $44,000. My fixed cost should be $20,000, giving me a net income of $24,000. You see, that's my fixed budget. This is what I expect will happen, right? And I can't change it because it's fixed. Now, what actually happened during the year? Well, I actually produced and sold 140 units. Okay, that's kind of good. Why? Because my sales were 105,000 instead of 80. Right? I budgeted for 80, came in at 105. That gives me a favorable variance of 25,000. Okay, let me explain to you the difference between favorable and unfavorable. Favorable is a good thing. Favorable, just as the word implies, it's a good thing. It's favorable. You see? Favorable. It means I sold more than what was expected. Okay? That's favorable when that happens. My contribution margin was also favorable by 6,400. How do we get these numbers, you might be asking? We take the actual results minus the budget. Actual results minus the budget. So 105,000 minus 80, it's $25,000 favorable. Why favorable? Because sales dollars came in higher than expected. Same with contribution margin, $6,400 favorable. My net income favorable by 6,000, 30 minus 24. Actual minus the budget. What about the costs, though, Dr. B? You're talking about the good stuff, but what about the not so great stuff? I'm so glad he asked. Let's take a look at our variable costs. 54,600 was the actual fixed cost. I only budgeted for 36,000. Okay, so 54.6 minus 36 is 18,600. Unfavorable. Why unfavorable, you might wonder? Because we're talking about costs. When your actual cost, is greater than your budgeted cost, that's unfavorable. Why unfavorable? Because you spent more than what you said you were going to. Yeah, that's why it's unfavorable. That's how I want you to think about it, all right? Same with fixed costs. $400 unfavorable. Yeah, actual minus the budget. That's how we find our variances. Right. So this is the thing with a fixed budget. We can't change it. It's locked in. It's fixed. You see what I'm saying? That's why I don't like fixed budgets. Now, I'm going to give you a couple of examples of organizations that use fixed budgets. And the best example I'm going to give you is the federal government or the state government, okay, or the city government. Most government organizations operate on what we call a fixed budget. The fixed budget tells us the revenue that we're receiving, revenue coming from your taxpayers and subsidies, and then all of your expenses, okay, providing things like infrastructure, utilities, maintenance, etc. Okay, and then all of the other government administrative functions. It's a typical government budget. They're fixed. I can't change it. Okay, if I have a sewer main break in the city and my budget only goes up to a certain amount for water and sewer, that's going to be a problem, okay, for the budget. So that's the trouble with fixed budgets. Another example of an organization that might use a fixed budget, a nonprofit organization. They typically use fixed budgets. Why? Because their revenue, their income, usually comes from things like donations, um, grants, etc. Okay? So those are fixed budgets. They're okay when they work. You know what I mean? But when you go over those costs and it's unfavorable, that ain't good. So that's why, for me personally, I don't like fixed budgets. Now let's talk about the thing I do like, and that's flexible budgets. Okay. Flexible budgets are great because we can make adjustments as time goes forward. Right? We always prepare budgets before the accounting period actually begins. Always. You can't make a budget as you're going through the month. I mean, that doesn't make sense, right? It's like saying, "Oh, Dr. B, it's March 2024. We should start doing the March 2024 budget." No, no. The budget tells the company what to do in the future, right? It's a roadmap. It's a plan. You can't create the plan as you're doing it. The plan's got to come before the action. So, all I have to say is your budgets always happen before the actual accounting period begins. Budgets provide different levels of what if scenarios, okay, when it comes to flexible budgeting. I like to call this best case, worst case. Best case, worst case. I'd mentioned capacity, right? We budget based off of capacity, 80%, 100%, 120% capacity. Or you could also say something like 60%, 80%, 100% capacity. It's like different levels, right? You could also say best case, worst case. Best case being 100%, worst case being 60%, and okay, or the average, being 80%. You see what I'm saying? Different levels. It's different levels. And it's based off of the level of activity. So after the accounting period ends, we evaluate based off of the performance. That's why I like flexible budgeting. We can make adjustments. Here's the example. I love this example because you can see, and this is just the budget, not the actual performance, but you can see the three cases, right? Best case, I produce and sell 14,000 units. Worst case, I produce and sell 10,000 units. And the probability, I produce and sell 12,000 units. You see what I'm saying? So take a look here. If I produce and sell 14,000 units, that's $140,000 in potential sales revenue. Why? Because we sell them at $10 a piece. That would also mean my variable costs, total variable cost will be $67,200, which means my contribution margin could be as great as $72,800. That's awesome, right? That's a lot better than $52,000 if I produce and sell 10. Then you see the fixed costs. The fixed costs do not change with the level of output. They stay the same. That's why we call them fixed costs. You probably remember that conversation from the second week of this course. So, long time ago, right? Take a look at the net income. So we take contribution margin minus total fixed costs equals our net income, right? $12,000 net income at 10,000 units produced, 32,800 at 14,000 units produced and sold. Overall, this gives us a lot of flexibility. Why? Because you got to think about the probability. Are you going to fall short at 10,000? Are you going to blow it out of the water at 14? Or are you going to end up at 12, which is the middle ground? So that's the cool thing about flexible budgeting. It allows for that variance, yeah? So total budgeted costs, how do we calculate it? We take the total fixed costs, in this example, 40,000, plus the total variable cost per unit, which is $4.80, times the units of activity, number of units we expect to produce. That gives us the total budgeted amount. Okay, now that we understand the budgeting part of flexible budgets, what about comparing it to the actual performance? Now, the year goes by, and here are the results. Okay, couple of things to look at here. We increased our sales price at some point during the year. Okay? Favorable sales variance is because the average selling price was greater than $10 a unit. We increased our sales price at some point during the year. Cool. We sold 12,000 units, and we expected to sell 12,000 units. Excellent. We raised our sales price by a little bit during the year. That gave us so instead of selling $120,000 in sales, We sold 125. That gives us a $5,000 favorable variance. Remember, it's favorable when we're talking about your sales being greater than expected, and it's also favorable if your costs, actual costs, are less than expected or less than the budget. So, okay, what about that? So we move down the variable costs list. For direct materials, I budgeted for $12,000 because I was going to sell 12,000 units. I still sold 12,000 units, but my actual direct costs, direct materials, came in at 13,000. Okay, why? You might be wondering, why did that happen? It's like, oh, my direct materials came in higher than expected. Here's the real reason why it happens. Prices change when you buy things, right? Think of it this way. You went to the grocery store to buy one orange, and you bought it yesterday for 50 cents. You go back to the grocery store today to buy one orange, and the price is now 70 cents. You see, it went up 20 cents overnight. That's because price of oranges went up. Because why? The cost of fuel to ship them to the grocery store went up. There was a shortage due to a drought, whatever. But you see my point. The same applies in business when it comes to raw materials. Raw materials prices change all the time. So we would expect there to be some type of direct materials variance. And that's why this happened. Similarly with direct labor, we budgeted for $18,000 of direct labor. We came in at $20,000 of direct labor. Why? We hired more skilled employees that demand a higher wage, hourly wage. Okay? So, yeah, that's going to cause an unfavorable variance in indirect labor. But what about the other stuff? Indirect materials, sales commissions. We see that both of those have a favorable variance. They came in less than budgeted. Why? I didn't use as much adhesive as I thought I was going to, so I saved $300 there. Why the sales commissions is lower? Well, I negotiated a better rate with my salespeople. Yeah. So total variable cost is unfavorable by 1,800. Contribution margin favorable 3,200. That's good. You'll notice that the fixed costs remain the same except for insurance. Now, what happened with insurance? I got a new insurance bill, and it went up by $200. Okay, so you have to put that in there too, giving us a favorable variance of net income of $3,000. But you see how it works, right? Now that's if it comes in perfectly, right? I came in right in the middle. It could have came in at 10,000. It could have came in at 14,000. But I would have been able to pivot because it's a flexible budget. You understand? That's flexible budgeting. Now, I've been talking about these variances. How do we find the variances? Well, as you found out, we take the actual cost minus the standard cost, also known as the budgeted cost. Okay? So, how do we find the standard cost or the budgeted cost? Let's talk about this here for a second. The standard cost is the cost that is used in a flexible budget to allow management to better understand the reasons for the variance. A standard cost is just like saying the budgeted cost. This is the expected cost. Okay? For example, I normally purchase wood for my hockey stick company at $10 per pound of wood. Okay? That's I normally purchase at that price. Because I normally purchase at that price will become my standard cost for direct materials, you see? That's why we call it standard. It's expected. It's the normal cost. It's the normal cost, okay? What we would normally pay. That's what a standard cost is. And we have standard costs for direct materials, direct labor, and factory overhead. Oh, okay. So we need to figure out a way for us to set our standard cost. And the idea is that we would set it based off of 100% operating capacity or efficiency. Okay? It's very normal for us to say that we operate at 100% efficiency or capacity, right? And because of that, it would help us to set our standard costs based on 100% capacity. So, for direct materials, I take the normal cost I would pay for the direct materials and I multiply that by the normal amount of the direct materials I would purchase. Quantity, normal quantity. You'll notice it says and grade. And grade. Why grade? Because you should know this, grade indicates the level of the quality of the raw materials. Grade is the quality of the raw materials. So the normal quantity and grade. Quantity and quality of the raw materials. That's what that means, yeah? So I take my normal cost, what I normally pay for it, times the normal quantity and quality that I would purchase. That's for direct materials. That's how I set the cost, standard cost for direct materials. What about direct labor? Labor, as you know, is the amount of time that an employee spends producing a product. That's direct labor, right? It's the amount of time times the hourly rate, right? So hourly rate times the amount of time that they're spending on producing a product. So rate times time, that gives me my standard direct labor cost, right? How do we figure that out, right? That's what the motion studies is. That gives us an idea of what their hourly rate is. The time studies, that's the amount of time that they're on average that they're spending on producing a product. I call those time studies. They're also known as time tickets, right? We use a timer, a stopwatch. Okay, we hit the stopwatch. We start it when the employee starts working on the product, and we stop it when they finish. That's what a time study is. And then lastly, we have our overhead. Variable overhead, as you know, it includes all of the other things like indirect materials, indirect labor, that type of thing, right? So in order for us to figure out the standard direct overhead, we usually factor it. Just like we did in previous chapters, in the previous weeks, we typically factor our overhead. and it's based off of something like an activity base, something like direct labor hours. That could be the activity base, yeah. So let's go through an example together of setting the standard cost. Here we have a company that produces baseball bats. Oh, I love baseball. I'm actually going to a game this Saturday. I'm very happy about that. It's opening weekend. Yeah. So here we have a company that produces baseball bats. And these are our standard costs. It takes 2.2 pounds of wood to produce one baseball bat on average. Okay, on average. Sometimes a little more, sometimes a little less. But our average or our standard is 2.2 pounds of wood for one baseball bat. We buy our pounds of wood for $10 per pound. Okay, 2.2 pounds times the $10 gives me a standard direct materials cost of $22. Okay, to purchase the wood. What about labor? On average, it takes my employees 2 hours to produce one baseball bat, and I pay my employees on average $15 per hour. This means I would have a direct labor cost of $30 per baseball bat. 15 times 2, yeah. What about overhead? Overhead, we're going to use a single plant-wide rate method here. And we're going to say that our overhead rate is based on, at the activity base, is our direct labor rate, 2 hours. And we'll say $5 per direct labor hour. All right? So our overhead in this example is $10 per baseball bat. That gives us a total cost per bat of $62. That is our standard cost. That is what we are budgeting to do. Okay? So our budget is $62 to manufacture one baseball bat, $22 of direct materials, $30 direct labor, and $10 factory overhead. So that's our budget to produce one baseball bat, okay? Our budgeted cost, $62, also known as our standard cost per baseball bat. Then I get to producing. And when I produce a single baseball bat, I find out a couple of things. The variances. Because remember, things change. The price of wood might go up. The hourly rate might go up. There might be a change in the indirect materials or something like that. So you can see that there will be cost variances. So I'm going to show you how to compute those cost variances in a very methodical way, because this is the part where it gets tricky, yeah? Cost variances is the difference between the actual and the standard cost. That's why we call it a variance. Variance means the difference, yeah? If the actual cost is less than the standard cost, the budget, the variance is favorable. If the actual cost is less than the budgeted cost, it's favorable. Yeah, absolutely. However, if the actual cost is greater than the standard cost, the budgeted cost, the variance is unfavorable. That means we spend too much. Yep. Okay. Now, how do we compute these cost variances? Well, the first thing we do is we identify the variances, okay? So we go through this cycle to analyze the variances. First is we prepare the reports The reports are the variance reports, what we actually spent versus what was budgeted. We compute and analyze those variances, actual minus the standard. We identify questions and their answers. Why did these changes happen? Oh, it's because of this. It's because of this. And then we take corrective action to reduce the variances. And then we do it all over again. How do we compute the cost variance? Okay, I'm going to break it down for you. This is the formula. It looks trickier than it is. I promise you, it does. It looks trickier than it is. I'm just going to walk through with you, okay, so that way it can help you to calculate the variances. Because there will probably be a couple of questions on your quiz for this chapter that you're going to have to compute some cost variances, yeah? Okay, so let me walk you through it. Here's the way we do it. First, we figure out the actual cost. And the way we calculate the actual cost is we take the actual quantity, that's the actual amount that we purchased, yeah, times the actual price. Right? That makes sense. What I actually paid. Actual quantity times the actual price. That gives us the actual cost. That makes sense. Okay, so far so good. Then I need to calculate the standard cost. Well, we know how to do that. We take the standard quantity, the amount I normally purchase, times the standard price, the amount I normally pay. So how do I figure out the cost variance? It's the actual cost minus the standard cost. You see? So that's the basic formula. Okay, it gets a little trickier, but this is the basic formula, and that's what I want you to remember. Actual minus standard.
Professor,
Yes, Ashanti, please.
so I see you got the excuse me.
You're all right.
I'm gonna just say the AQ times the AP, then you got the SQ times the SP. So you said minus that. Will the actual ever be lower than the standard
Yes, yeah.
to give you a negative number?
It'll give you a negative number, which will actually be favorable. Yep.
Okay.
Because when your actual costs come in less than your budgeted cost, that's a good thing, right? You're saving money. But yeah, it can be. Yeah, that does
Okay.
happen from time to time. It's not terribly frequent that stuff like that happens, but it does happen. Yeah, great question. All right, so that's the basic formula. It gets a little trickier, okay? So just keep that in mind. But I just want you to try to remember this formula because you'll see how it changes when we talk about direct labor and stuff like that. Okay, let's jump into it. So direct materials and direct labor. This is where it gets a little trickier. I'm going to layer things, okay? I'll layer things. I'm going to try to make this as easy to understand as possible, all right? So, so think about this basic formula here, actual cost minus standard cost. To find actual cost, we take actual quantity times actual price. To find standard cost, we take standard quantity times standard price. That makes sense, okay? Actual minus standard gets us the cost variance. Just keep that in mind. Now we're going to layer things and make it a little bit more complex. Here we go. Let me walk you through this, all right? And hopefully it's not terribly complex, but it can be, right? It can be. So you know your basic formula. Actual cost minus standard cost gives me the cost variance. There might be times where you have to figure out what we call the price variance or the quantity variance. The price variance tells us the difference in price, right? What I actually paid versus the standard price. You see? Actual price minus the standard price. Let me walk you through this. To find the price variance, we take the actual price minus the standard price. We do that first. And then we multiply that by the actual quantity, which I actually purchased, right? So again, I'm going to walk you through this one more time. Price variance tells us the difference we actually paid in comparison to the standard price. Okay, actual price minus the standard price. So we do that part first. Actual price minus the standard price. And then whatever that difference is, we multiply that by the actual quantity. And that amount will give me the price variance. Okay? That's price variance. Remember, price variance is a difference in price. Actual minus the standard. We multiply that by the actual quantity that we purchased. That gives me the price variance. Now, let's talk about the quantity variance. The quantity variance is the difference in the actual quantity in comparison to the standard quantity that I normally purchase. Okay? Because sometimes I might purchase more or less than what I normally do. It's going to give me a quantity variance. So to calculate the quantity variance, I take the actual quantity minus the standard quantity. And then I multiply that by the standard price. The standard price, you see? Actual quantity minus standard quantity times the standard price. That gives me what we call the quantity variance, the difference between the actual quantity and the standard quantity. Okay? I know it seems so complex, doesn't it?
Professor,
Oscar.
yes. So in order to get the cost variance, we must have to do first price balance and quantity balancing. Is that,
Uh,
is that
to get the direct materials variance, yes.
so first we had to do those two first, and then we get the actual cost balance here.
The direct materials variance, yes.
Okay,
Absolutely.
got it.
Okay, very good. Now let's work through the example. Okay, so let's go through the example so that to help you even better to understand it. So here we have our baseball bat company. Yeah. Here we go. So here's the deal. We got actual quantity and standard price, and standard quantity and standard price. To show you these variances. So here's the data. We produced and sold 3,500 baseball bats. We ended up using 1,800 pounds of wood at $21 per pound. That's how much we actually paid. Our standard budget is 1,750 pounds at $20 per pound. So that means I paid $1 more per pound than I normally pay, and I ended up using 150 pounds of wood more than what I actually use. You see? So let's calculate these costs. we take the actual quantity times the actual price. Actual quantity, 1,800 pounds of wood. Actual price per pound is $21, giving me an actual cost of the wood, $37,800. All right. Now, what about my standard? Remember, the standard is like the budgeted amount, what I normally pay. I normally purchase 1,750 pounds of wood at $20 a pound. That's what I normally pay. That will give me a normal or standard cost of $35,000. That's what I budgeted for. So that means I have a direct materials variance 2,800 unfavorable. Unfavorable. How did I calculate that? Let's look at this again, okay? Let's come down to our formula. First, we take the actual cost minus the standard price. How do we get this? Let's figure out the price variance first. Price variance, we take going back to our other slide here. Price variance, we take the actual price minus the standard price times the actual quantity. So, actual price, $21, minus the standard price, $20, times the actual quantity, 1,800. That gives us the price variance of $1,800 unfavorable. See how we got there? Now let's do the quantity variance. Remember, the quantity variance formula is actual quantity minus the standard quantity times the standard price. Actual quantity, 1,800. Minus the standard quantity, 1,750. That's 150, right? Oh, I'm sorry, it's 50. It's 50. Times the standard price, 20. 50 times 20,000. See how we got there? Now, of course, to find the direct materials variance, we're taking our price variance plus our quantity variance to give us our direct materials variance. Make sense? Did we do okay?
Yes, yes, it does make sense.
Okay. It's a very difficult concept for people to understand. So that's why I wanted to make sure that we spend our time understanding this, because a lot of students get tripped up in this. It took me a long time to understand this. It really did. When I took an exam recently to become a certified management accountant, and I got to tell you, I struggled with some of the questions on that exam, and they were related to cost variance. And so, because here's the thing, this course, the information I give you in the questions, it's straightforward. I'm giving you, the data that you need. In some of these exams, like the CMA or the CPA, they're going to give you a whole lot more data than what you actually need, right? So that's why understanding those formulas is so important, and being able to break them down, right? So that's why I wanted to spend as much time with you as I could explaining this part, because that is by far Probably one of the most difficult accounting concepts for most students. So hopefully you got it. All right. That's direct materials. We're not done yet. We still got to get through direct labor and factory overhead. So after we figure out our variances, then we go through the analysis. The management says, well, why did this happen? What caused these variances? Oh, who's responsible for these variances? Is it the people working on the line? Maybe not, because they didn't do the purchasing. But what about so management has to figure out what happened. That's what this slide's telling us. And then they make adjustments accordingly. So that's direct materials. What about direct labor? Direct labor works very, very similarly. Okay? Here we have similar information. Okay? Remember, we produced and sold 3,500 baseball bats. We ended up using 1,700 labor hours to produce these. We paid our employees $33 per hour. Okay? The standard, it normally takes us for 1,750 pounds of wood, it normally takes us a half an hour to produce one baseball bat at $32 per hour. Okay? So let's think about this. Our standard quantity, we produced 3,500 units times half hour per unit. That's this. That's the standard. Yeah. So let's figure out our actual quantity and rate and our standard quantity and rate. Actual 1,700 hours at $33 per hour gives us an actual direct labor cost of $56,100. The standard is 1,750 hours at $32 per hour, giving us a standard quantity and rate of $56,000. That's a $100 unfavorable variance. So let's figure out how we got there. And again, it works very similarly. Okay? So we have rate variance. Rate variance, of course, is the difference in hourly rates. And the efficiency variance, how efficient we are at producing. Okay? Here are the calculations. To find the rate variance, just as we did before, in a similar way, I like this slide. Personally, I like this slide. We would take the actual minus the standard times the actual quantity. The actual minus the standard, 1,700 minus the standard of 1,750 is 50, right? So the difference is 50. Was it times the standard or the actual? Now I forget. I'm sorry, times the actual. Actual minus the standard, 1,700 minus 1,750, that's 50. Wait, was it actual or standard? I keep forgetting now. Actual. So 1,700 minus the 1,750, that's 50, times the actual, $33. So 50 times 33, 1,700. So that gives us the rate variance. We follow the same process for the efficiency variance. And the efficiency variance, we're taking our I can never remember that part. We're taking our actual minus the standard times the standard price. That the actual 1,700 minus the standard 1,750, giving us 50 times the standard 32 gets us 1,600. 1,700 minus the 1,600 gives us a $100 unfavorable variance. We good? Direct labor? You see how it works, right? Very similar. Okay. Very good. All right. Cool. And then, of course, what does management do when we see these variances? Oh, maybe our employees are too skilled. They made the bets in lesser hours, but we paid them more, right? So they saved us time in terms of efficiency. Their efficiency was good, but the actual rate wasn't so good, right? We paid $1 more per hour. So that means that the employees are high skilled and they probably have a higher rate. So management makes decisions based off that type of thing, and then they helps them to analyze the information. So that's direct labor. And of course, one of the last variances we got to figure out is overhead. With overhead, as you know, overhead is based off a couple different things: indirect materials, indirect labor, utilities, maintenance, etc. So we can figure out our variable rate per unit. In this example, one single unit has a $2 total variable overhead rate. Okay, and the fixed cost is 12,000. Remember, fixed costs don't change regardless of the level of output. So here we have a flexible budget. And you'll notice that we have 4 levels of capacity for this flexible budget: 70, 80, 90, and 100%. In this case, we came in at 80%. And because of that, we are saying that our production, we're going to produce 4,000 units. These are our variable costs. It's $2 per unit, right? So $2 times the 4,000 gives us 8,000 total variable overhead costs. The rest of it's fixed, 12. 8 plus 12 gives us $20,000 of total factory overhead. So that's cool that we figured that out based off of a flexible budget. But what about this standard overhead rate, right? We got to figure out what the overhead rate should be. Most companies select an activity base like direct labor hours. Yeah. So let's go through that process of figuring out how to calculate this standard overhead rate. There's 3 steps that we follow. The first is determine the allocation base, like direct labor hours, for example. Second is to predict an activity level. 80% will produce at 80%. And the third step is to compute the standard overhead rate. And we do that by taking the budgeted overhead at the predicted activity level, 80%, divided by the standard allocation base at the activity level, number of hours. Okay, so let's walk through an example. And this is the extrapolated part of this, yeah? So we take the actual production times the standard amount of allocation base times the standard overhead rate. In this example, we have 20,000 divided by 2,000 hours equals $10 per direct labor hour. To calculate the overhead variance, we take the actual overhead minus the standard overhead. Actual minus the standard gives us the variance. Yeah, that one's a little easier to break down. Let's plug that into our example to show you how to calculate those variances. Yeah. So we have two variances here for you to learn. One is called the controllable variance. The other one's called the volume variance. Again, works very similarly. Actual minus the standard times the actual price on the controllable variance side. Actual minus the standard times the standard on the volume variance side. It's just a matter of applying that formula that we learned earlier. Yep. That's how we calculate controllable variance and volume variance respectively. Take controllable variance minus the volume variance gives us the overhead variance. All right. Controllable variance, how is that calculated? Take the actual minus the standard at times the actual units. Yep. Actual minus the standard gives us the controllable variance. The overhead variance report looks like this. Again, we're taking our actual results minus our budgeted amounts. That gives us our variances. It's favorable if your actual cost is less than the budgeted cost. Right? It makes sense. It's unfavorable if the actual costs are greater than your budgeted cost. Those variances, what can we learn from the product variance cost? They will tell us about the direct materials variance, direct labor variance, and the overhead variance. And this slide summarizes all of those other variances that we calculated, right? So this nice summary slide just kind of shows you how everything's connected. We can also figure out variances based off of our sales. Okay, we call these sales variances. The idea here is that we're analyzing our overall sales, right? Based off of changes in those sales. So we take our actual minus our budgeted sales. So here we have some data, different company. Now we're at a golf company, okay? We produce golf balls and golf clubs. We actually sold 1,100 golf balls. We expected to sell 1,000. Our sales price was $10.50. Our normal sales price is $10. In terms of golf clubs, we produced and sold 140. We were going to try to sell 150. Our sales price for golf clubs is $190. We normally sell them for $200. So there's your variance amount. Just as before, we follow that same type of process to find out the variances. So here we have the sales price variance. Sales price variance is the difference in the sales price, actual minus the budgeted. Okay, so the actual sales price times the actual amount, yeah. So yeah, we follow the same exact formula that we showed you before. Actual minus the standard times the actual for the sales price variance. And then for the sales volume variance, actual minus the standard times the standard. Yep. And of course, we do the same thing with overhead. With overhead variances, we can find the variable overhead variance, the fixed overhead variance, and we can even break that down even further to find spending variances, efficiency variances, spending variances, and volume variances. Oh, and controllable variances. All of these variances help management to kind of get a better understanding of the differences that they're paying for certain things over time. Here are a couple of examples of this. The variable overhead variance, we take the actual variable minus the standard variable to find the variable variance overhead. When we apply the same process for the fixed overhead. Take the actual fixed minus the standard fixed to find the fixed overhead variance. Same exact formula process applied. Actual overhead times the actual variance rate gets us the actual variable overhead. For the applied, it's the standard rate times the actual standard variance. Actual variance rate. Actual minus the standard gets us the variance, you see. The same exact concept. Same thing for the variable variances, using our example and applying it. So you can see how that works. And then we do the same exact thing for fixed overhead variances. Yep. Same process. And one of the last things you need to know about variances is in accounting, we need to adjust. Because with variances, the idea here is that we're finding the differences. And when we do that, we need to account for those differences. And the way we do that is through adjusting journal entries. So at the end of the month, respectively, we would make adjusting entries for things like direct materials, direct labor, factory overhead. You get my point. So in order to make those adjustments, depending on whether it's favorable or unfavorable, will determine whether that variance is a debit or a credit. So here we have an example for direct materials variance. So this would be the type of journal entry I would make for a direct materials variance based off of that adjustment. And in this case, our actual cost was greater than our standard cost, meaning unfavorable. And so when it's unfavorable, it's going to be a debit amount. If it's favorable, it will be a credit amount, you see. And these variances, they tie into your asset account as a contraflow account. This is an example of the direct labor variances. You can see in this case, we had an unfavorable rate variance, but a favorable efficiency variance. And then for the overhead, our volume variance was unfavorable, so we debit, but we had a favorable controllable variance. You see? So those are the type of adjusting entries that we would make. Okay, that was a lot of information and a very difficult concept, again, for most students to understand. So my recommendation as you're working through these calculations is I want you to remember a couple of key things, especially when it comes to the variances. One is right here, and remembering the basic components of variance calculations. Actual minus the standard times the actual to find that first part of the variance, and then actual minus the standard times the standard to find the other variance. That's the typical format to follow when it comes to calculating those smaller variances. You know what I mean? But just keep in mind actual minus standard. That uh, to find the overall variance. Yep. So hopefully this was helpful, not too confusing. I know that it's again not the easiest thing to follow. So did we do okay? Is anyone totally lost or does it kind of make somewhat sense?
Well, I'm fine with it as long as I know how to use the formulas. I'm
Right.
sure I can get through the direct labor balancing.
Yeah, that's exactly it, Oscar. Once you start with your basic cost variance formula, you know, to find the actual, we take the actual quantity times actual price. To find the standard, we take the standard quantity times the standard price. Actual minus the standard gives us that cost variance. Once you've gotten that down, it's somewhat easy to figure out the other variances. It's just a matter of breaking it down a little bit further. Um,
Yeah, so for me, the key is like the formulas. If we know how to use the formulas, then I think we have all the other datas and we can just put it together and I'm sure.
exactly. That's
Yeah.
exactly it. Yep. So just keep that in mind, and so as you're working through the quiz and the other questions, you'll be all right.
Yeah.
Yeah. Awesome. Very cool. Thank you.
Thanks, brother.
My pleasure. Are there any other comments, questions, or concerns about cost variance or anything that we talked about today? Are we doing all right?
No questions.
Awesome.
Want to try. That's all I can do.
Yeah, I know, Ashanti. I'm telling you, this is probably one of the most difficult concepts for most students to understand. It was difficult for me to understand, honestly, when I first learned it, and it still is. It's not the easiest part to go through.
It'd be so much information.
Yeah, yeah, it is. It really is. But just like what Oscar had mentioned, it's a matter of no, remembering those formulas and plugging in the values. Yeah, it can be complex for sure. Yeah.
Good job explaining, Professor, as
Oh,
always.
thank you. I appreciate you saying that. It's not easy with these more challenging concepts because oftentimes I got to figure out ways to break it down even further.
Right.
Yeah. Cool. Thanks. All right. So, as a reminder, where are we? We are in week 11 for this weekend. You have your cost variance hypothesis, which I see some of you started to look at already. There's 3 of you already in here. Just as before, it's a lecture, short video. You're doing your commentary just as you've done before, so very well done so far. Um, So you have your hypothesis, one original and one response, and then you'll have your Chapter 23 quiz. So again, if you ever need anything, you need further clarification or whatever, you can email me, you can call me, you can set up office hours. You know I'm here for you, okay? I sincerely appreciate all of you and all of your efforts, and I'm very confident you'll do well. Just remember, take it easy, try to do a little bit of work early on. It usually helps, okay? Thank you all so much for your time today. Sincerely appreciate all of you. Have a wonderful rest of your night. Thank you so much. Take care. Bye-bye.
Yes, sir.
Okay.
Thank you. Thank you.